Experienced day and swing traders know that the market will not gyrate around wildly forever, and at some point, the market will consolidate and begin to trade more normally. I'm Seth Freiberg, the head trader of S&B Capital's options trading desk here in Manhattan, and traders on our options desk are actually experts at trading for profit when the market is less volatile and channeling around in ranges. These are actually excellent trading opportunities for options income traders. In today's video, we'll be teaching you a simple technique for making money on stocks that actually aren't moving, which is a skill you'll be needing soon as the market stabilizes. So stick around. I think you're going to find this useful. Hi, I'm Seth Freiberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so one of the most common measures of market volatility is the CBOE VIX index, which monitors the pricing of the SPX index options, the options derived from the S&P 500 index. And as you can see, over the last 5 years, the VIX index spent a great deal of time below 15, which means that the market is behaving more like a flat channeling market or a slow grinding upward market. But since the COVID-19 crash in February and March of last year, the market has been extremely volatile, and so the VIX has remained over 20 for an extended period of time, as you can see. But this is not going to last forever, and you'll need trades that work in less volatile environments, the kinds of environments that emerge after the market has had a huge rally and is resting and essentially digesting the move and normalizing it. So let's take a look at the chart of Google, which is formerly known as Alphabet. And as you can see, the stock has a pattern of breaking out above a level and then channeling for lengths of time like it did after it broke out above 900 in April of 2017, and then again did so in October of that same year, 6 months later, when it broke out and pretty much stayed above 1,000 for the rest of the year. And so a trader might logically think that Google could stay in that range for a while, and thus there'd be little opportunity for a meaningful move in the stock as it absorbs this current price level. So the technique we'll be teaching you in this video involves the use of put and call options, and so we just need to quickly make sure everyone has a firm grasp on how they work. So hang in there while we do a quick review of stock options, otherwise known as equity options. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. And what's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of the stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares of that stock at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. Okay, so now let's move to December of 2018. And as we mentioned, Google has broken out above 1,000 and is pretty much living there. So suppose that we sell 5 puts at 1,000 at that support level that we've identified, with the theory that if Google sells off to 1,000, it will bounce off of that level. So even if we're assigned the shares at 1,000, we'll likely make money on those shares. And if 1,000 is never hit, we'll simply pocket the put premium we collected. So the puts are going for $1.75, as you can see, but remember, that's $1.75 per share, and each options contract represents 100 shares of stock, so you multiply that by 5, and if you do the math, it comes out to $875 collected for selling those 5 options. Now, before we get into exactly how this trade plays out, if you want to learn the details of 3 other option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the prices you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so now let's move to the day those 5 options expire, and as you can see, on that day, January 19th of that year, Google had rallied and closed at 1137, so like we discussed earlier, you just get to pocket that $875 that you collected originally. And so the way that this approach works, we'll just sell another set of puts at that same 1,000 support level as soon as the original set expires. And so we sell 5 more of those 1,000 puts expiring about a month later on February 16th for $1.34 each, resulting in our collecting another $670. Now, this time it's interesting because our thesis turned out to be correct, and Google bounced right off of that 1,000 level and closes at 1094 in the day that second set of puts expires, resulting in our being able to again just pocket the $670 that we sold in terms of put premium on that February trade. So now let's go ahead and take a look at the cash flow we've collected so far from this campaign. As you can see, we made $875 from the January puts and $670 from the February puts. And so we won't run through every month, as that would be a little tedious. But if we move now to June 15th, we can see that Google not only held that 1,000 support level, thus all of the puts we were selling in the interim at that 1,000 level all expired worthless and became profit for us, but in fact, Google bounced to 1152 by mid-June, and so we can surmise that the market's now accepted that Google will maintain that $1,000 level of support. So at this point, we can feel more comfortable moving our short puts up to that 1060 level off of which Google had bounced, as we can see from the price chart on June 15th. So at this point, we've been through the January through June trades, and to catch you up, here's the cash flow picture through June. And because Google's kept testing that 1,000 level, there were occasions during those 6 months where the puts got much more valuable because the closer the market gets to those puts, the more traders are willing to pay for them. And as you can see, the May puts were quite expensive, bringing in over $5,000, but then the market began to bounce by the time we sold those June put options, and so they returned to a more normal price level. And so by June, we'd collected over $11,000, and so now, as I mentioned, we'll now start selling the 1060 puts under the premise that that new 1060 is likely to hold. And so for the July expiration, we collect almost $2,000 for those 5 puts. Now, moving forward to mid-November, by that time, the whole market had begun to sell off. And as you can see, the market actually blew through that 1060 level in late October, but recovered by options expiration on November 16th, and so those puts expired worthless also. But as you can see, by virtue of the market selling off in the fall, the premiums on those 1060 puts had become really valuable, and much more so than in the earlier part of the year, as those who held Google stock bid up the prices on those puts, which they may have been using as protection for Google dropping below 1060. And so as you can see, we collect a great deal of additional put premium so that by November, we had pocketed over $30,000. And so we go ahead and sell the Decembers. And now the prices on those are huge because we're selling the puts right below where the market is trading, and we collect a whopping $34.75, which comes out to $17,375 in the process for all 5 puts. Okay, so now something really interesting happens in December, and that is that the market sells off such that by the day of the December put options expiring, Google has sold down to $9.79, causing the put shares to be assigned because remember, the one we sold those puts to now has the right to sell them to us for $10.60, which they certainly would take advantage of when the shares could be sold in the open market for $9.79. And so we end up being required to buy those 500 shares represented by the 5 puts at $10.60. So here's what we're going to do at this point. This month, we're going to sell the $10.60 calls, not the puts, expiring in January. Now, why would we sell the calls? Well, that's because this is a premium collection strategy. And so we're not really aiming to own the shares. We're aiming to collect premium from selling the puts. So once we get assigned the shares, then at this point, we're now trying to dispose of the shares, which we bought at $10.60, by selling calls at that exact same price. So that once the market bounces, the buyer of those 5 $10.60 calls will simply exercise those calls if the market gets above $10.60. And so at that point, we'll have sold those shares back at no loss and collected just some additional premium by virtue of having sold the calls to dispose of those 500 Google shares that we were assigned. This, incidentally, is known as the wheel strategy to options traders, where you sell puts on stocks, and if you do get assigned the shares, you sell calls on those shares until the shares are assigned away from the calls that you sold. And sure enough, as you can see, Google bounced to $10.98 on the day the January options expired, and so those shares are going to get called away by whoever we sold them to. We will be required to sell those shares at $10.60 even though they're trading for $10.98, and as a result, we've neither won nor lost on those shares. We bought them for $10.60 when the shares were assigned to us as puts in December, and we sold them for the same price, $10.60, when they were assigned away as calls in January. And so we no longer have those shares, and instead, what we're left with is all of the premium that we collected during the year, where we were selling puts and then reverting to selling calls until the shares were assigned away in January of 2019. And so if we look at the final calculation, we take the total that we mentioned we had collected before November 15th, add that to those huge December put premiums that we sold when Google was close to $10.60, and then add the call premiums we sold for the January expiration to dispose of those 500 shares we were assigned from the December puts, and we end up collecting over $54,000 in a little over a year. Now, comparing that to just buying those shares when we first started this campaign, which was back in December of 2017, when the shares were trading at $10.78, when you move to January of 2019, those shares essentially haven't moved, with a gain of $20 per share for a total profit of $10,000. Whereas purely collecting put and call options premiums, we end up collecting 5 times that, $54,000 in cash. And so what I'd like you to take away from today's video is that when a stock goes nowhere like Google did over that period where we were executing the options premium selling strategy known as the wheel strategy, there are ways to make a boatload of money through selling options premiums as opposed to outright owning the shares. You don't need price movement to make money in the market. You just need to know how to use options premium selling strategies in strategic ways that professional traders understand. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just go ahead and head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.